One mistake at age 63 can quietly add thousands of dollars to your Medicare premiums, and most retirees don't realize it until it's already too late. Michael thought he did everything right, but one decision ended up costing him more than $4,800 a year. Michael retired at 62 after saving consistently for 30 years. By the time he left his job, he had built a traditional IRA worth around $600,000, and he had a clear strategy for how to handle it. During the early years of retirement, while his income was low and his tax bracket was nearly empty, he planned to move as much money as possible from his traditional IRA into a Roth IRA. The idea was simple: pay taxes now at a lower rate and avoid paying them later. He had done the research. He had studied Roth conversions, read financial articles, and understood the long-term benefits. Over 2 years, he converted $180,000 into a Roth IRA. He even paid the taxes from a separate savings account so the full converted amount could stay invested. His financial advisor told him he was doing everything correctly. Then he turned 65 and enrolled in Medicare. Not long after, a letter arrived from the Social Security Administration. His Medicare Part B premium was not the standard $22.90 per month most retirees expect. Instead, it was $443.10 per person per month. That meant he and his wife were paying an extra $4,112 per year compared to another couple with the same current income. And here is the part that surprised him the most. The income that triggered this increase was not from a job. He had not worked in 3 years. It came from the Roth conversions he completed at age 63. Income he had already paid taxes on. Income he thought was finished. This is one of the most expensive retirement mistakes tied to Medicare premiums, IRMAA, and Roth conversions, especially at age 63. He made the right move at the wrong time. And this exact situation is happening to thousands of retirees right now because they are following good strategies without understanding how the timing affects Medicare. This video is for educational purposes only and is not tax or financial advice. Always consult a qualified professional before making decisions about your specific situation. My name is Kevin Retires. Every week, I break down tax rules, financial traps, and strategies that help retirees avoid costly mistakes that most people never see coming. If that sounds helpful, subscribe now and turn on notifications so you never miss a video. Today, I'm going to explain exactly why age 63 is one of the most important years in retirement planning when it comes to Medicare costs. I'll walk you through the Medicare 2-year look-back rule that most people don't fully understand until it's too late. I'll show you exactly how IRMAA works using confirmed 2026 numbers. And I'll give you a clear action plan based on your age right now, whether you are 59, 62, 63, already on Medicare, or somewhere in between. This is not a theoretical issue. This is happening right now because nobody explained how Medicare premiums are calculated. Most people know Medicare Part B has a monthly premium. What most people don't know is that the amount you pay depends on your income from 2 years ago. In 2026, the standard Medicare Part B premium is $22.90 per month. If your modified adjusted gross income from 2024 was at or below $109,000 for single filers or $218,000 for married couples filing jointly, you pay that base rate. But if your income goes above those thresholds, Medicare adds a surcharge called IRMAA, the income-related monthly adjustment amount. And this is where things become expensive. IRMAA is not gradual, it works like a cliff. If your income exceeds a threshold by even $1, your premium jumps to the next tier. For a married couple, crossing that first threshold can increase Medicare costs by nearly $2,000 per year. And this increase is based entirely on income from 2 years earlier, not what you earn today. Here are the 2026 IRMAA tiers. Below $109,000 single or $218,000 joint, the premium is $22.90 per month. The first tier jumps to $284.10 per month. The second tier increases to $365.60 per month. The third tier rises to $447.10 per month. The fourth tier reaches $528.60 per month. And the highest tier goes up to $689.90 per month. For a married couple in the highest bracket, Medicare Part B alone can cost more than $16,500 per year. Same coverage, different income from 2 years ago. Now here is the rule that changes everything. Most people start Medicare at 65, but their premiums at 65 are based on their income at age 63. Not 64, not 65, age 63. That means every financial decision you make at 63 directly determines what you will pay for Medicare. IRA withdrawals, Roth conversions, stock sales, rental income, all of it gets reported on a tax return that Medicare will use 2 years later. If you are 62, your income affects your second year of Medicare. If you are 61, you still have time to plan. But if you are 63 right now, every decision you make before December 31st can impact your Medicare costs for years. And here is where most advice goes wrong. Most financial strategies focus only on tax savings. They tell you to convert when your income is low. That advice is not wrong, but it is incomplete, because low income at age 63 can still trigger higher Medicare premiums later. You can pay very little tax on a Roth conversion and still end up paying thousands more in Medicare premiums because your income crossed an IRMAA threshold. Taxes and Medicare premiums are calculated separately, and almost nobody explains them together. Let me show you what this looks like in real life. David is 63. He retired at 61 with a $420,000 IRA and a small pension. This year, he converts $120,000 into a Roth IRA. His total income becomes $139,000, which puts him above the first IRMAA threshold. 2 years later, when he enrolls in Medicare, his premium jumps to $365.60 per month. That's about $1,950 more per year. Over 2 years, that's nearly $4,000 in extra costs. Same strategy, different timing. Thousands of dollars saved or lost. Sandra and Thomas are both 63. Sandra earns $48,000 from consulting. Thomas receives $22,000 from Social Security. They also sold stock this year with a $60,000 gain. Their total income reaches $245,000. 2 years later, their Medicare premiums increase significantly. They end up paying nearly $8,000 more over 2 years. They didn't do anything unusual, they just didn't know timing mattered. Margaret, on the other hand, has a pension and Social Security totaling $64,000. She never crosses IRMAA thresholds. Her Medicare premium stays at the standard rate. Most retirees are like Margaret, but if you have control over your income, you are not. You are David or Sandra, and your decisions matter. If this video is helping you understand something important, hit the like button so more people can see it, and subscribe for more breakdowns like this every week. Age 63 is unique because 3 different financial systems collide at the same time. Income taxes encourage you to generate income, ACA subsidies encourage you to keep income low, and IRMAA penalizes higher income. These systems don't work together, they conflict, and you need to balance them carefully. Your Medicare premium is always based on your income from 2 years earlier. This pattern continues every year. The reason age 63 matters most is because it sets your first Medicare premium. But the system never stops. It continues throughout retirement. If your income drops due to a major life event, you may be able to appeal using Form SSA 44. Qualifying events include retirement, divorce, or loss of income. But planned decisions like Roth conversions do not qualify. There is also something called the widow penalty. When one spouse passes away, the surviving spouse files as single. The income thresholds are cut in half. The same income can suddenly trigger much higher Medicare premiums. This can increase costs by thousands per year. Roth conversions done earlier can help reduce this risk. Here is your action plan. If you are 60 or 61, this is your best window for Roth conversions. If you are 62, start planning carefully. If you are 63, review every income decision before the end of the year. If you are 64, manage income alongside Social Security decisions. If you are already on Medicare, check if you qualify for an appeal. And if your income is consistently high, consider strategies like qualified charitable distributions. The key takeaway is simple. The rule is not hidden, but the timing is rarely explained clearly, and that lack of clarity is costing retirees thousands of dollars. The retirees who succeed are not the ones who save the most. They are the ones who understand how each age changes the rules. Age 61 and 62 are planning years. Age 63 is the trigger. Age 65 is when the bill arrives. Michael paid nearly $5,000 extra in Medicare premiums. Not permanently, but unnecessarily. He made the right decision at the wrong time. This is Kevin Retires. If this video helped you understand something important, like the video and share it with someone in their early 60s. And tell me in the comments, did you know about the 2-year IRMAA rule before this? I read every comment, and your questions become future videos. This is Kevin Retires.